Send a text or voice note.
Message us at 925-3261 on WhatsApp today and get active with Radio Cayman.
Radio Cayman, the voice of the Cayman Islands.
Radio Cayman, maintaining the innovation.
Live from Radio Cayman Studio, this is
Money Sense, bringing an informed financial perspective to the Cayman community.
A very good morning and warm welcome once again to Money Sense. I'm Simon Caudry and I have the distinct pleasure of welcoming back Mr. Richard Mapurura. Richard, good morning and welcome back to the show.
Good morning, Simon. Thank you for having me back on the show.
Well, my pleasure. I normally do research with you to figure out when you were last on, and it's this time for once. It's been less than a year.
Oh, really?
It was March 2025 we last chatted. So a lot's changed in that time. But in fact, a lot's changed both geopolitically, a lot's changed economically.
Yes.
A lot's changed financially, a lot's changed in our little region. But a little bit has changed for you as well. You've moved into a new role. Just tell us a little bit about that so the listeners know who they're dealing with now. You're a new Richard.
Same old Richard, but in different shoes now. So yes, it's true. Thank you so much for having me again on the show. I have moved on. So I've joined RF Bank,
Yep.
And I've assumed the role of the CEO in the Cayman office. Obviously, most of these things are subject to approvals by our regulators, so subject to approval by the regulators. But exciting time to be sort of like channeling the ship in the space for our clients in the Cayman Islands, working for the group and making sure that we give service to our clients.
Excellent. Now, one of the things that RF is quite well known for, of course, is the RF Economic Outlook. I was trying to get the
Yes,
and
yes.
That takes place in early February or
Early February,
early to
yes.
mid-February.
Yes.
And it's this, I don't know how many years it's been running, but it's been going on for a few years. But it's always, to me, been quite an interesting, very interesting full-day event, isn't it? Where you've got speakers from government, you have speakers from economics, finance, industry.
Yep.
And it's one of those sort of events where people learn things. So maybe you could just give us a little bit sort of a preview of what we might expect in next month's one.
No, so it's around the corner. It's on the 11th of February, as you rightly put, and we have titled this one, the theme for this conference this time around, AI Tsunami, navigating the surge of essentially really looking at intelligence innovation. So great speakers lined up to come for the show, international speakers as you alluded, and obviously we have government speakers speaking as well. But just to unpack, this AI sort of like world for our audience to see where things are going.
Well, it's been flavour of the month, actually, AI and that topic for about a year and a bit now. When you think about, and we'll come on to markets as a good segue there, when you think about how markets have been responding to this AI boom.
Yes.
Everybody and their taxi driver is owning NVIDIA. Everybody and their taxi driver is talking about NVIDIA.
Yes.
And everybody's also saying it's gone up an awful lot. And it's gone up an awful lot for a long period of time.
Yes.
And Newtonian physics doesn't necessarily apply to stock markets. That things that go up must come down. But how worried do you feel, and how worried do you hear people, and do you sense people are about the prospects for these sectors that have boomed so long and so hard? They've gone up so fast,
right,
and for such a sustained period of time. How much of a worry do you consider that?
I thought you were going to use the word bubble, but thank you. You did not use that word bubble, because that word is becoming very popular in the markets and also in my own house, because I have a 2-year-old and she loves bubbles. So should we say maybe...
Is she predicting the stock market? What are we going with this?
I don't know. But coming back just to looking at, should we say things are overextended? Are things overstretched? And sometimes people are asking, are we in a bubble or not? I think there are some pockets of the market which are surely sort of like extended in terms of pricing, and they are now expensive. But I think there are reasons, and this time, I had to use this phrase that says this time is different, but I surely believe that this time is different. Most of these companies, examples that you mentioned, they are making real money. Okay, they are making real earnings. If you look at their balance sheets, they have free cash flows. These are real companies. When you look at the amount of investments they are making now, we spoke about AI, we spoke about infrastructure, and we speak about just the electricity components that are needed in this whole space of AI. These companies are really operating and making money. This is different from what we saw, I think, between 1999 and in 2000. The dot-com boom and bust and the bubble and so forth, right? So I think it's a balance to understand that these companies are actually making money, and there's a reason to the price tag, right? The price is high for a reason. And I would like most of our audience to come to a sense where we start looking not only just on the valuations, because yes, valuations are stretched, and there's an argument that, hey, look, the S&P is probably now priced at, 23 times now, compared to an average of a long-term historical of about 16 to 17 times. But there's a reason to some of these names, okay? But you need to also look at the growth component. What is the growth that is coming from these companies? Most of them, they've been growing very well, and sometimes it explains why the price keeps on going a little bit up.
I will sort of go into that a little bit more, but I want to sort of a little bit play devil's advocate, just to have a little bit of fun in the conversation. And I agree with you that companies like Nvidia or those that are making some of the chips that are used in this technology are seeing real cash flow. Absolutely no doubt about that.
Yeah.
One of the things they've been doing, and this has been in the last 3 to 6 months or so, is they've actually been also, though, investing in some of their customers.
Yes.
So they've been spending a couple of billion here, a couple of billion there, saying, we're going to own 20-30% of our customer. And then miraculously, that customer then says, I'm going to place a $1 billion order
buy from them
for your chips.
Right.
Now, we saw some of that sort of experience in previous booms.
Yes.
And some companies historically got into trouble for some of the nuanced accounting, perhaps we might call it, associated with that. I'm not suggesting that's the case, but sometimes those sorts of developments can be early warning signals of actually we've seen this growth rate, and you're right, there's been a huge growth rate in spending, but in order to sustain that sort of growth rate to support the stock price, then companies start to do things which are a little unusual, a little bit more strange compared to the normal. Does that worry you at all, and does that concern you for the prospects of some of these companies where some of the growth prospects are coming from actually their own investments?
Yeah. No, I think that is a cause of concern, to be honest. I think one of the biggest major concerns has been the amount of investment that has gone ahead. How much of that is going to be recouped, or how early and how much are companies actually going to get the benefit out of these investments? Some of these hyperscalers, the big companies, have put in a lot of money in these AI, sort of like infrastructure, energy, and all these places that we're talking about. I think in 2025 alone, they crossed over $1 trillion, if not $1.5 trillion. 2026, again, projected about $600 or so billion to be put in again. Good amounts of investments. The biggest worry and concern that we all have in the market now is how much of that is going to be recouped in terms of returns to the company, because we are yet to see some of the returns coming back. At the moment, we are just on the investment phase. So to your point, yes, it gets a little concerning because some of these transactions that they are entering with sort of like the related parties are promises to buy in the future. It has not yet happened, okay? But the spending part is happening today. The worry is, are we going to recoup these expenditures?
Is another worry some of the developments which we often don't know about until they're announced that come from China, whereby we saw, early last year, I think DeepSeek suddenly came out. This was a model that the Chinese researchers had developed, and suddenly came out, and most analysts sort of said, it's actually pretty damn good.
Yes.
And so they developed that without some of the technology that the Western world is using,
Right.
without some of those things, and they developed it in a way which consumed much less power and therefore was more efficient. Now, domestic US ones and Western ones have actually obviously caught up, accelerated, but there is a worry, isn't there, that actually there might be other things around the corner which we don't know about because of lack of transparency of information at this juncture, which could fundamentally alter the equations under which all the models are built to value these companies.
100%. It's technology, okay? So it evolves.
Innovation,
Innovation
is by definition
exactly.
unexpected.
So, completely agree.
Yeah.
And I think that's the fear that is always out there. So NVIDIA at the moment, if you're reading statistics, you're hearing that their technology is maybe 3, 4, 5, or even 6 or 10 years ahead of some of the technologies, but that window can close any other day. So that fear is very hard to price, but that has to be always in the minds of investors that things can change overnight.
And you talked about the growth rate. I think it's a really important point to bear in mind, and I'm slightly less playing devil's advocate now, because I think when you think about investing, you look at a price and go, oh, I could have bought it at $5, it's now $10. I could have bought it at $10, it's now $20.
Yes.
And you go, oh, that's regret. And you should never really invest like that. And then some people say, well, okay, but this company is making hardly any money and its price is crazy.
Yes.
But I think the analysis that one often should remember in mind is for many, many years, almost decades actually, Amazon made close to $0 or made losses for a long period of time. And its price was in the $80, $90 range.
Yes.
And so the ratio of earnings to price was infinite because it was zero earnings.
Zero
and
earnings,
a price that was
and there was
positive.
a price, yes.
And of course now it's the de facto shopping tool.
Yes.
So you've got to sometimes look beyond the current to
100%.
the future, haven't you?
Yes. So investing is really not in the now. It's really trying to project what you think is coming into the future, because that's what you are actually investing for. You are not investing in the price and in the earnings that have been made today. So that sort of like idea of looking into the future is very critical. So sometimes, yes, a company might not be making earnings that are good now, but what is the projection? The projection is very important.
The problem, Richard, is that I understand what's going on now because I can see it around me.
Yes.
What's the magic tool I need in order to understand what's going to happen in a year's time? That's the missing ingredient that we're all waiting for you to tell us about.
If we all have that sort of like magic ball, we won't be sitting here, to be honest. No. But there's a lot of reading, there's a lot of understanding, research, and that's where I think market intelligence helps, and sometimes advisors come into play, because there are people who are spending time trying to understand what these companies are doing, what are they doing every day, what are the models, what are the sort of like expectations, what are they seeing, and all sorts of things that then shape to say, which of these do you think is going to be a success? It's not always that you pick the right one, but when you do enough work, you're likely going to pick the right one.
That's an interesting point, isn't it? Because we can all read the press and we go, oh, Nvidia's the hot topic, or another company's the hot topic, and often you then get excited by reading about something, and you make an investment and it goes very well, and you go, oh, I'm a genius.
Right.
You could easily, and many other people will then have made an investment and have gone terribly badly. And so you've got to be very careful to make sure that you do the good, but you have to accept the bad. And therefore, being a little bit more diversified, being a little bit more broadened in how you invest is a very prudent approach. Don't presume that you can predict the future perfectly.
Yes.
Presume you can't, and therefore prepare accordingly.
And then you diversify. Agreed. Yes.
Now let's look a little bit broader at markets, though, because the stock market, there's a lot of talk over in the public press about the Magnificent Seven and how they've been the driver of stock markets. And the reality is they mostly have. You look at a lot of other companies and they've been suffering. They've been suffering from high costs. They've been suffering from weak consumer demand in some cases because of cost of living, inflationary pressures.
Right.
So do you worry, though, about the percentage of market growth that's been concentrated in such a small component of the index, and there's actually a much broader range of companies which are saying things aren't that great, and things aren't that great because real people in real towns and villages and cities are struggling with cost of living and expenditure costs and just lifestyle costs.
Yes, yeah. So I think there you're speaking predominantly focusing sort of like on the US space of things. Okay, so in terms of the US market, yes, there's been somewhat a containing concentration. So you're right to say that the S&P 500 assumably has 500 companies, but it has like slightly more. I don't know why they still call it S&P 500.
It very rarely actually has 500. It's often 497
it's
or
like,
502.
or 503 or whatever the number. But in that 500, I think at the moment, a greater component of that is being supported by about 10 companies. Okay, and we spoke about what these 10 companies are doing and how their balance sheet are looking like, which is a great thing. But is it a concerning thing? Somewhat, yes. But I would also argue to say that if you look broadly outside of the US on other markets, look at the UK, look at Japan, look at Europe, look at emerging markets. Interestingly enough, the US is actually lesser concentrated than some of the markets out there. So mostly it's not a completely new thing. It's increasing in the US, but it's not a new thing that in markets you get these regions being concentrated by either 10, 15 or companies that are doing very well. And in this particular case, it's a theme that we have, I think, probably going to be around for quite some time, which is technology.
Interesting one, because we're going to take a break in a short while, but I want to then come back and talk about international versus domestic or US investing.
Right.
But when you look at some other markets around the world, like in France, the index is the CAC 30.
Right.
In the UK, it's the FTSE 100. So suddenly the top 5 or 7
They
10
just
companies
automatically become
much bigger, whereas 500 there's a much
Yes.
broader range. So
Right.
actually you've got a better chance of being diversified in a much larger pool. But let us take a short break, and then straight after we're going to come back and talk right about international versus US investing and what the market is looking at.
Okay.
Radio Cayman, maintaining the innovation.
On a daily basis, making it easy to connect with you, our listeners. Add us to WhatsApp today, 925-3261. That's 925-3261.
Radio Cayman.
Send a text or voice note.
Message us at 925-3261 on WhatsApp today and get active with Radio Cayman.
Radio Cayman, the voice of the Cayman Islands.
Radio Cayman, maintaining the innovation.
This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands.
And now, more Money Sense.
Welcome back to Money Sense and our conversation with Richard Maparura, CEO of Royal Fidelity. Now then, Richard, just before the break, you segued perfectly to a discussion on international investing, international equity markets. And the reason it was a perfect segue is because one of my questions that I wanted to put to you was that there's been a recent narrative, and I say recent, almost since the beginning of this year, which isn't that long now.
Right.
So we should probably have said Happy New Year, but that, we've glossed over that, which is an investing narrative which says it's almost, and I might paraphrase it wrongly, but it's anywhere but the US. So there's been this chat, maybe the US is becoming slightly less investable to a lot of investors than other markets because of the political turmoil, because of just the uncertainty as to what's going on, some of the restrictions, the uncertainty about tariffs. And actually, foreign markets, and by that I mean non-US markets, have actually performed really rather well so
Yes,
far this year,
yes.
and didn't do too badly at all last year either.
No, last year they actually outperformed the US.
Yeah.
Yeah. So
which is unusual for the US to
Very
be a laggard
unusual,
in this regard.
yes.
What do you make of that? And so yeah, it's such a broad question. But do you think that is a viable long-term strategy that international markets outperform the US? And where do you see this going?
I think you bring up a very interesting point. So 2025, interestingly, after about a stretch of almost 15 years of US outperformance, and we ended up having this term called US exceptionalism, right? So the US, for the first time in 15 years, actually underperformed the rest of the world. It was quite interesting. It was one of the things that actually surprised me. It surprised me in a positive way, to be honest, because there were some expectations that given everything that was happening, the valuations in other pockets of the market globally, there were opportunities for those places to do better. Okay, so yes, the US actually slightly underperformed the rest of the world. And you said anywhere than the US. Yeah. Okay, I think that might be a dangerous bet. Okay, first, you just mentioned before we took our break, that the US is a massive economy. Okay, I think there's so much free flow of capital in the US. There's so much technology and innovation in the US that we cannot completely overlook the US for the rest of the world. I would probably end by saying maybe everywhere else with the US along the way.
Everywhere with the US.
Everywhere with the US, not anywhere
Anyway,
but the US. Okay.
When you look at non-US markets and you look at some of the valuation, I mean, the components of those markets are very different often.
Yes.
They haven't got doesn't always have the likes. They can't have an Nvidia because obviously that's the US, but there's often a different sectorial distribution.
That's true.
And
yes.
so in a sense, you've got quite interesting diversification by adding a little bit more exposure to non-US markets, because you haven't got the same exposure to the Facebook, you haven't got the same exposure to Google, to Nvidia, because they're not in non-US market indices.
Yes.
Is that in and of itself a compelling reason to make sure you are diversified internationally?
Yes. So I think you make a very good point. So yes. So if you think about sector diversification, you can actually do sector diversification by using regions. So you can say if you go, let's say the UK, it's predominantly maybe financials or
Predominantly
industrial,
rainy,
right?
that's a different story.
But you can say, okay, if I want a little bit more exposure there, you can actually use the region, but to get a sector exposure. But the advantage that you get when you do that is you also stand to benefit for the region in itself. Okay, so if you think about everything that is happening in Japan, for example, think about Japan. It's going in its own different direction. So if you get exposure to Japan on a sector basis, but then you also get exposure to the region. So everything happening in the country, the currency of the country, the fiscal policy of the country, so you tend to benefit. So if you then build your portfolio like that, it becomes somewhat more diversified, and in a way, I think that's the better place to do it.
It's fair to say the world as we live in today has its reasonable degree of political turbulence.
Oh, yes.
I'm being very careful how I phrase this.
I know.
Has a degree of political turbulence. And one of the historical truths about markets is when there's political upheaval, when there's military upheaval, people tend to rush to invest in what they've historically considered safer assets, US domestic assets, US equities, US treasuries and such like. Now, we've got unrest in, well, Central and South America. Right. We've got unrest in the Middle East, and the Middle East has a tendency of causing disruptions around the world.
Yes.
But what strikes me as unusual in this scenario is that actually some of the unrest that is happening, and it will cause oil prices to maybe go up a lot in the short term, but then maybe fall in the long term. But it might not actually have the same precedence. So where people used to rush to say, oh, I must buy US treasuries because of this turmoil.
Right.
Because actually some of the turmoil is originating from the place. So maybe some of the lessons that we've historically learned about how to navigate in uncharted, dangerous times aren't quite applicable today. What do you make of that statement?
That's an interesting one. So first, I have to be careful that I don't lose my traveling visas, okay, when I make comments. But I like that point. So one most important thing is there's a whole talk about the debasement of the US dollar. Okay, so you're right in the sense that the US dollar is the safe currency or the reserve currency.
People rush to it.
If
you buy it, it goes up.
Yes, but I'll tell you one statistic that I just read recently, that now gold has become the highest reserve currency. It has just eclipsed the dollar. Okay?
And silver and some other metals
and
as well.
Of course, and silver is just shining, right? It's doing amazing things.
That's a terrible part. I'm sorry, I can't let that one go live on air without saying that.
But my point I wanted to make is that I think the market has come to a realization that there are places where it's more safer and insulated from whoever is causing the problem. And that's places like gold. Okay, we have seen what happened in Russia back in the days when their reserves were sort of like frozen. Yeah, so the market has now come to terms and say, okay, instead of holding my reserves in dollars, where else can I hold them? So I think there's a drift now moving away and getting into these neutral places where you just, for example, hold your gold and you are almost insulated to whoever is causing the havoc, but you are in a safe haven sort of like asset.
And that's your explanation as to why we've seen such record runs in gold and silver.
Amazing.
It's about the safe haven aspect of it.
Yes, the neutralized safe havens. Yeah, of course there are other use cases for, like, let's say silver. Okay, there's a lot of electrification going on, EVs coming on, the data centers being built. So there is also a demand story. So you can look at a demand and a supply story, but also there is this place where these are havens as well, just for safety.
Let's talk a little bit about oil prices, because I think a lot of people listening to the show in Cayman will think, oh, cost of living's been a difficult one for me over the last couple of years. Prices are a fair bit higher than they used to be.
Yeah.
And now we're starting to talk about a war in the Middle East, and we're starting to see issues in Venezuela. And both of those are oil producers. Both of those are critical. Or Venezuela could become a critical component in the oil supply.
Yes.
But Iran already is.
Yes.
And the last thing anyone wants is more disruption to oil prices or oil supply, which causes prices to go up, and therefore the cost of living to go up further. It costs more to fuel your car, costs more to turn on the electricity. But the reality is that political and military upheavals in these countries may well have long-term benefits in terms of fixing some of the issues that exist. But in the short term, it's very difficult to see a path other than probably higher prices. Because if you start to see invasions in some of these countries, that by definition is disruptive.
Right.
And rising oil prices do cause consumer difficulty, don't they?
It does.
So how do consumers prepare for that? Is it just be wary? I mean, what else can one do?
So you're right that obviously rising oil prices have implications to inflation, which is really just cost of living to consumers. But there's a few things to unpack there. So you touched on long-term and short-term, and I think that's the right way to look at some of these things that are happening at the moment. You brought in Venezuela and you brought in Iran. These are two countries. Venezuela has the largest oil reserves in the entire world. Okay, I think about 300 billion
of
barrels.
A particular good
Of
type,
a
because
certain
it's
type.
easier to refine.
Actually, for them, they don't have a really good type. Venezuela, they have kind of like the one they call the heavy one, which is a little bit hard to refine. But I just quickly wanted to bring these two together. Venezuela, the issues in Venezuela are assumingly supposed to insinuate that more supply is supposed to come from Venezuela, right? What is happening in Iran is assumingly supposed to say lesser supply is to come because it's going in the other direction. But if you look at the current status quo, Iran is bringing in over 3 million barrels a day at the moment. Venezuela has only been bringing in less than $1 million. So if you bring these two numbers together, net on a short term, mathematically you think it's a net negative. Okay, so the reaction to the oil price immediately,
the disruption
to
of
your
3
point,
million
exactly
is greater than the benefit of 1 million.
Exactly. So now I think we have seen WTI. I think around about January the 8th or so, when this story started coming up, from a lower below 60 all the way up to 60. So we can see the price movement in the direction of increasing. So yes, there will be issues where the market is trying to say, where's the immediate direction? So immediate impetus might be, it's going to go lesser supply means more prices. Okay. And that certainly will affect consumers. But the other side to look at oil prices is also, which is a little far-fetched away from consumers, is that higher oil prices, they actually tend to benefit producers. They also tend to benefit governments. So sometimes trying to say where's the oil going to go outside of us just for consumption for our cars in terms of the market implications, I think it's always better to be diversified, because there's always going to be one person or one entity benefiting from either an oil price going up or oil prices coming down.
Unfortunately, in Cayman, we're in the latter category. We don't benefit from oil prices going. And I think one of the things that often is overlooked is you think oil prices are going up. Oh, my car's going to cost more to fill up. Yes, that will be true. Although
Yes.
with the increasing hybridization of cars, the benefits are a little bit managed because you're getting better fuel efficiency.
Right.
But definitely also your CUC bill is going to go
Oh,
up.
yes.
But I think what is often overlooked is, and it really shouldn't be, is actually almost every price will go up, and because almost everything is shipped in. Now, ships require oil, or different type of oil, but effectively a crude refined product to come to Cayman, and so their cost of providing a service goes
Yes,
up,
yes.
which means they charge more for every item that goes on their boat, which means every item that comes to Cayman costs a little bit more. So in Cayman, because of the way that we operate as an economy, we're not just saying, oh, it's a problem, my car's going to cost more, that's fine. No, everything's going to cost
It
a
will
little bit
affect
more.
a lot of things. Agreed. Yes. So it's really a channel.
So
It's
that's a great way to have some good news, isn't it?
Yeah.
But go on, so it's a channel. Sorry.
Now, I was just going to say it affects a lot of things, as you rightly put, right? So it's not only just the price of oil. So it goes into production, it goes into manufacturing, and then it filters all the way through to the consumer. So it affects a lot of things along the chain.
Now, the optimists in various administrations that are supportive of these regime changes will say, but this is going to have long-term benefits. You know, we can
Right.
potentially have a stable supply out of Venezuela, a stable supply out of Iran. The problem, of course, not problem, but the reality, perhaps is a better word, is that might well be true, but you can't suddenly turn on the taps. You can't fix many decades of leaks, of disruption
Infrastructure.
within a week or two,
Yes.
or within a month or two. So
Right.
assume they're right, and they may well be, but to be right, it will take a year, 2, 3, 4
will take
to
some
get
time.
to that time.
Yes.
And so even if the long-term benefits are as predicted by those in favor of this action, we as consumers are still going to have short-term pain, short to medium-term pain of getting there.
Hopefully for long-term benefits.
Yes.
Yeah. So you're right. Some companies have already expressed the same sentiment that you're saying. So Chevron is already in Venezuela, and they are committing to wanting to do this, but they know it's not going to be a short-term game.
There's a lot of money that needs to be spent.
There's
first
a lot
all.
of money to be spent. Infrastructure has been bad, so there's a lot of investment to go in. There's also need for commitment from these administrations that even if someone is no longer in power, okay, are these terms going to stand?
Yeah.
Okay, so those fears are in play. But again, hopefully that these things, they'll plan out and play out into the long term for the benefit of everyone. And you're right, Venezuela has reserves. If they can be channeled out, that will be a good supply.
More
to the
supply,
world.
lower prices.
Yes.
But just be warned, it will take some time.
It will take some time.
Well, we are, as always, out of time before we've got remotely through our list of potential topics that we're going to discuss. Richard, it's been a real pleasure having you join us again.
Always very good
in
to be here.
January here on Money Sense. So thank you very much.
Thanks, Simon.
Just a quick note for our listeners. Richard did mention the RF CEO conference 11th of February. If you want to learn more about AI, you want to learn more about markets, do look that up online on the internet and maybe even register to attend. It's going to be, I think, a really good event with a lot of really exciting and very, very informative speakers. So I encourage people to give that a bit of attention. And just remind you that today's show will be available as a podcast on YouTube. And encourage you, if you have any question or topic you want us to consider, send us an email to moneysense@cfakman.ky. With that, thank you for joining us and tuning in. And please do rejoin us on Money Sense in 2 weeks' time.
Little Cayman Bragg.